connecting investors, financial institutions, and businesses around the world. Luxembourg is a centre of excellence for global finance. Recognised for its unique international financial expertise, Luxembourg is solution-driven, stable, and open to innovation. A pioneer and global leader in sustainable finance, we help build a better tomorrow today. An international financial centre and a European capital. Luxembourg is an exceptional and welcoming place to work and live. Discover what we can do for you.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Hello everyone, good morning. Welcome to our Focus On event on Capital Markets Union, CMU, the Capital Markets Union. It is an initiative to create a single capital markets to better serve consumers, investors, and companies. The overarching goals of the Capital Markets Union is to provide greater sources of financing at a lower cost, to provide financing to small and medium enterprises too, to create new opportunities of investment to investors, to help Europe deliver on its Green Deal and on its digital agenda, which are cornerstone, and to reinforce the competitiveness of the EU bloc. It has 4 building blocks. So greater sources of financing, heightened efficiency of capital markets, an increased attractiveness of the EU to investors, and a strengthening and harmonization of supervision at the EU level. How did it come to light? How that whole idea came to light? In 2008, with the global financial crisis, we've realized that the EU was maybe overly dependent on bank financing, hence the need to develop other sources. Nevertheless, reducing the Capital Markets Union to an initiative that was triggered by crisis management challenges wouldn't be right. It's more than that. It's a long-term agenda. It's a long-term initiative. It's a long-term agenda of structural reforms and financial intermediation in the EU. So several years down the road and several action plans down the road, where is it sitting now? Have we reached a level playing field? Have we lowered barriers to the Capital Markets Union? Have we diversified sources of financing adequately? Let us spend the next hour taking a look at the many intricacies of the Capital Markets Union. For instance, let us see if UCITS, then AFME, and then ALFI, the latest to join the bandwagon, have managed to create an integrated funds market. Let us see to what extent the development of a securitization market has proven efficient, and more so in times of turbulence. And let us see if onshoring clearing to the EU is also contributing to the ease of doing business. Let me first welcome for our first keynote speech, Pablo Portugal, Managing Director from AFME. Hi, Pablo, welcome aboard.
Thank you very much, Inès, for that introduction, and good morning to everyone. I would like to begin by thanking Luxembourg for Finance for the invitation to discuss the progress on the Capital Markets Union. So the title of this session asks if the CMU is still relevant in 2023, and my answer to that question is a resounding yes. Capital markets will need to play an increasingly important role in the EU economy in the coming years and decades. And I would mention three main reasons for this. The first one is that it is clear that the enormous investment needs associated with the transition to a more sustainable economy and the challenges and opportunities of digitalization cannot be funded solely through government support programs or the provision of bank loans. We need deep capital markets to be able to mobilize the EU's significant savings pools and private investment resources to enable the green and digital transformations. Secondly, and this is a related point, strong capital markets are increasingly vital to strengthening the EU's competitiveness and prospects for economic growth and job creation in a global landscape. Risk capital is needed to finance technological innovation and the many businesses in Europe with high growth potential that can expand rapidly and generate the jobs of the future. So it is important to be able to channel capital into these businesses. And I would say that for households, it is also important to be able to have investment opportunities to grow their wealth and be able to save for retirement. As we know, there is a demographic challenge that is going to put pressure on pension systems, and we need to be able to ensure that households can be able to save, to grow their wealth, to have an adequate retirement. A third reason relates to financial stability. The various developments that we have seen in the last few years have underscored why the EU needs a strong and resilient financial system that is able to withstand sudden economic shocks. And deep capital markets can certainly be a shock absorber and help to strengthen the overall stability of the system. So all of these points, I think, remain as relevant as ever. I was pleased to recently see that EU institutional leaders continue to stress the importance of the CMU and stress that this needs to be a priority in the current legislative cycle. We recently saw that representatives of the European Parliament, the Council, and the Commission issued a joint statement pledging to push forward the CMU agenda with ambition and speed. And they also said they will show political courage and determination to conclude the legislative work on all outstanding CMU proposals. So this is indeed an ambitious goal, but I think we should very much welcome this ongoing prioritization of the CMU at the highest institutional levels. What matters, of course, is not just concluding the legislations, but also ensuring that the outcomes are ambitious and that they help to advance the agenda when it comes to growing capital markets and achieving further EU integration. There have been some, I would say, important achievements in the last few years when it comes to kind of expanding the EU's capital markets capacity. And I'll mention a couple of those. One key example is the EU maintaining its global leadership on sustainable finance. Clearly, the EU is the global leader when it comes to the issuance of green bonds, and I'm pleased that Luxembourg is among the leading member states in that space as well. Another area where we have seen progress is in the fintech ecosystem. We have seen that the number of EU fintech unicorns has grown in the recent years, and more member states are offering regulatory sandboxes to facilitate innovation. So that is also a very good development. However, despite these achievements, I mean, it's fair to say that overall, the capacity of EU capital markets remains undersized, especially when compared to the size of the EU economy and, for example, the United States, which has much larger capital markets. In some areas, we have not seen the progress that we hope to see, and I will talk about some of those areas a bit later. So the question facing the CMU is not whether it is needed, but whether policymakers and market participants, can generate the momentum needed to undertake the reforms to fulfill the CMU objectives and achieve ambitious progress. I think there needs to be real political commitment to expand the size and capacity of EU markets at all levels. So a number of important reforms are under consideration at the moment, and more are to come in this Commission's mandate, including the long-awaited retail investment strategy. I'm sure that other sessions in the event will discuss some of these proposals in more detail. Let me highlight two areas that are particularly important when it comes to wholesale markets. One of those is securitization. Uh, as we know, the EU remains a bank-centric economy. I mean, we certainly want to see more equity finance, but for many businesses, and I would say that the bulk of SMEs, funding will continue to come in the form of bank loans, and that is not a bad thing. Bank finance is suitable for most SMEs and will remain so in the future. But for that to work, we need to ensure that securitization functions properly as a mechanism, providing that crucial link between bank finance and the capital markets. And I think this is one of the most pressing aspects of the CMU agenda, as a well-functioning securitization market is an essential tool to transfer credit risk away from the banking sector to markets and to recycle capital into new lending to support SMEs and corporates. Securitization can also be a powerful tool to allocate capital to supporting the green transition. And here we should note that it is estimated that 44% of the funding required to meet the Paris requirement will be needed in the form of loans, bank loans to businesses and households. So securitization can play a crucial role in ensuring that balance sheets, banks have the balance sheet capacity to enable those loans. So Europe's nascent green securitization market has has the potential to be an important enabler and should be supported in the coming years. We have recently seen an agreement reached on a new framework for an EU green bond standard that includes a specific treatment for securitization within that framework. So that is a very welcome development, and we look forward to seeing how that new regime will perform in the market in the coming years. Hopefully, with a view to supporting the growth of the EU green securitization market. Um, as we know, the framework for simple, transparent, and standardized, STS securitizations, rightly constituted one of the building blocks of the CMU when the project was launched. I think it was in 2015. Yet the ambition to scale up the securitization market in Europe has not yet materialized. It's fair to say that the market remains subdued, and I would say, vastly below its potential. Given, as I said earlier, that the EU is a bank-centric economy. Multiple factors, I think, have contributed to this situation, but I mean there is a broad consensus among market participants when we discuss these issues with banks and investors and other players, that aspects of the regulatory regime, could do with more proportionality, as they, disincentivize or not quite incentivize banks and investors to engage with securitization. So I think we need to look at certain aspects of the regulatory framework, both on the supply and the demand side. For example, in the context of the current CRR3 discussions, the European Parliament has put forward sensible proposals for transitional adjustments to the prudential framework for banks for securitization. until a wider review is undertaken. And we at AFME think that those proposals are very sensible, and we're hoping that they will be taken forward in the current trialogues on the CRR3. On the demand side, I think we also need to look at regimes like Solvency II when it comes to insurance company investors, and also requirements that affect the sort of investment landscape when it comes to securitization. For example, requirements on due diligence, transparency, and other areas that may be disincentivizing institutional investors from engaging with this asset class. Let me turn now to another critical area in the CMU agenda, and that is the promotion of equity finance. The EU has an equity gap when compared to some global peers. And just to give you one figure on this, EU domestic market capitalization of listed shares accounted for 10% of the world's total in 2022. And that was a decline from 18% in the year 2000. That outpaces the sort of decline of EU GDP as a share of global GDP. So this situation, I think, has been a combination of several factors, including an ongoing trend of company delistings. We see fewer IPOs, and also we're seeing that a number of big companies in Europe have been attracted to list in the US, possibly given the prospect of a higher valuation, for example, in New York. So we need to look at the various factors that are driving this situation. In the UK, we have also seen that these issues have caused concern, and the UK has recently taken steps to reform its company listing rules to encourage promote the attractiveness of London as a financial center. The EU is, of course, also looking at reforms regarding company listings in the Listing Act package that is currently under consideration. Public and private equity risk capital are really crucial because they are the most appropriate mechanisms, we think, to finance many high growth businesses that are seeking to expand rapidly or to invest in a new technology and to make their operations global, for example. So supporting these high growth businesses is really vital to economic growth and job creation. And equity is really a well-suited form of finance for this objective. I think here we need to work on measures that strengthen Europe's primary markets, but also the secondary markets ecosystem, because both are complementing and interdependent aspects when it comes to the equity finance ecosystem. I think the Listing Act is a really important initiative that has the potential of boosting the competitiveness of the EU markets. And there are several proposals that the Commission has tabled that are very welcome. For example, lowering the free float requirement or supporting the possibility to use multiple vote share structures across the EU. However, we need to get the balance right between providing more flexibility to issuers and reducing costs, while at the same time, maintaining adequate levels of legal certainty, transparency, and investor protection. So that balance is really crucial. And for example, one area that we need to look at is proposals to put hard limits on the number of pages allowed in the prospectus document. I mean, we think that is not the right way forward, given that we have businesses with varying business models, varying needs that are seeking to list, and therefore we need to have flexibility when it comes to the design of the prospectus document. However, as I said, listing rules are not the only aspect here. We also need to look at the attractiveness of the secondary markets, because this is really crucial also to bringing investors and companies to EU markets. Important debates are currently underway in the MiFIR review, looking at market structure for equities, fixed income, and other asset classes, as well as the design of potential consolidated tapes in these instruments. So these debates are currently in trialogue, and we're hoping to see ambitious outcomes that will help to boost the liquidity of EU markets and position Europe as an attractive investment destination. Let me conclude with a few thoughts on the importance of competitiveness as a principle when it comes to designing regulatory frameworks. Financial markets in the EU or in any other jurisdiction do not function in isolation. They are interconnected, and financial centers are effectively competing with each other. And this is especially true when it comes to wholesale markets, where market players have the potential to invest in different jurisdictions and have choices to make when it comes to accessing liquidity pools in trading, in clearing, and in all market areas. So the EU needs to ensure that its regulatory frameworks, not only support financial stability, which is of course vital, and investor protection, which remains key, but also we need to ensure that they remain competitive in a global landscape. That they serve to advance the objective of growing capital markets in Europe. I think that is a really crucial test and being able to attract international players. So a strong focus, I think, on the principle of competitiveness is really crucial in taking forward the CMU agenda. And that applies, I think, to all market areas, trading, clearing, ensuring that investors have the right options and products to deploy their capital, etc. Let me conclude by saying that, we've always known that the CMU is going to be a long-term project. It is not an initiative that has a short-term endpoint where all the actions are kind of fulfilled and they stay there. The progress is always going to be incremental, but we need to make sure that each step is ambitious as possible and that the outcomes are meaningful in terms of advancing the CMU objectives. So I would stress also here that the work needs to happen at the national level. We have discussed the EU level proposals, but clearly some crucial aspects of growing the capital markets are a member state competence. So, for example, taxation frameworks, the design of certain retail investment programs and pension systems. These are all kind of aspects where the regimes are at the national level, and they are really also crucial when it comes to growing the local capital markets ecosystem. So the member states also need to do their work in supporting the common CMU agenda. So I will stop there. I would like to again thank Luxembourg for Finance for the opportunity to share these thoughts with you. And I look forward to engaging with many of those in the audience on these debates. I will now give the floor to Emmanuel Gutton, who is Director for Legal and Tax at ALFI, who will be moderating a session on an integrated fund market in Europe. Thank you very much.
Thank you for these insightful thoughts, Pablo. I'm now extremely pleased to welcome my two distinguished panelists, Sheila Nicoll, who is Senior Public Policy Advisor at Schroeders, and Martin Parks, who is Managing Director at Global Public Policy Group at BlackRock. We will talk together about one specific aspect of the Capital Market Union, which is the development of an integrated investment funds market. As you may recall, two of the key objectives of the Capital Market Union package initiative in 2020 was first to make the EU an even safer place for individuals to save and invest long term. Another objective was to integrate national capital markets into a true single market. What happened since then? In November 2021, the Commission published the first CMU package, containing in particular a review of the LTIF regulation and a review of the Alternative Investment Fund Manager Directive. Since the launch of the UCITS in the 80s, which removed many barriers to allow retail investors in the EU and beyond to invest collectively in liquid assets, and I would say mainly listed securities, barriers have also been lifted over the last 10 years to facilitate the collective investment into alternative asset classes by professional investors with the Alternative Investment Fund Manager Directive. The measures adopted under the context of the CMU initiative are aimed in particular at broadening investment opportunities for retail investors. This is particularly the case with the LTIF regulation. As you may know, the objective of which is to channel investments by professional investors and retail investors to finance the real economy, meaning projects that need long-term capital, such as infrastructure projects. For my first question, I will turn to you, Sheila, and I will be interested to get your views on this evolution of the fund industry over the years. Do you actually observe the removal of barriers and the establishment of an integrated investment funds market? And what challenges do you see, in particular as regards the aim to improve retail investors' access to investment opportunities and increase their participation in capital markets? I think you are on mute, Sheila.
Thank you very much, Emmanuel. I apologise for that. And thank you very much for inviting me to come and give some reflections on the funds industry as it has evolved. It's interesting using the word integrated. It's certainly a word that was used in the context of CMU around capital markets. Depending what you mean by that, it seems to me that we've got integrated markets, pretty integrated markets already, in the sense that I think funds have blazed a trail in terms of cross-border activity, whether that's both in the EU and to elsewhere in the world. So we've already got quite an integrated market. In thinking about improving retail access to investment opportunities, I think it's also worth reminding ourselves that actually we as funds already provide good access. We are part of, play an important part in enabling investors' money to be channeled into European and other companies. So offering risk management, diversification, easy access, and so on within a regulatory environment that has evolved over time. So just maybe a little bit of a reminder of how we've got to where we are. The UCITS directive, of course, dates back to the 1980s. I think we got to UCITS 6, so it has evolved and the regulation has evolved and developed in response to markets over time. But they are the original authorised funds. With quite prescriptive rules around what you can invest in, how you operate the fund, but with diversification requirements, but they are capable of being marketed to a very wide audience. We then got AIFMD, the Alternative Investment Fund Management Directive, which actually takes a rather different approach. It focuses on the manager rather than on the fund, with far fewer prescriptive rules around what the fund looks like, but with limitations on who you can market it to. And then the LTIF, which we're talking about today in particular, is a subset of effectively an AIF, an alternative investment fund, but one which invests in longer term assets and where perhaps you can't get your access to your money for a longer period. So that sort of developed from the 80s, 2011, I think it was, we got AIFMD, in 2015 we got the original LTIF. But that's not just to say that we sit there and say, well, that's the end of it. We need to think about the next stage of evolution in this process. And I do think that it's important for European investors to have a range of funds that they can choose from to meet their different needs. And also for different companies to have different sources of finance and capital. So, but for me, one of the challenges that we face is that I, for example, have lived and grown up in a world where open-endedness, daily liquidity was sacrosanct. And I think we need to change thoughts and mindsets particularly as we're looking for opportunities for retail investors to invest in a wider range of assets, and particularly a wider range of private assets. We need to change our mindset. And particularly, there's been a tendency to equate illiquidity with riskiness. And I think we've got to forget that, we've got to change that approach. Just because I can't get my money out does not mean the fund is any more risky, provided that the manager is running the fund as I expect the fund to be run, and my expectations are being met. And it's been made very clear to me, if I'm investing for my pension in 25 years' time, why do I need to be able to get my money every day? Or at least why can't part of my portfolio be in less liquid assets? So I think that's the sort of mindset that we're needing to change, that there are systems, a lot of our systems are based on daily dealing, and a lot of investor expectations are on daily dealing. But I think we need to perhaps change our thoughts and attitudes to that. To go back to the question of integration, you asked whether we have an integrated funds market. I think there have been those who said that an integrated market would be bringing the UCITS rules and the AIFMD rules together. But as I've explained, I think they're quite differently structured. And it's no bad thing that we have slightly different labels, because in that way, it can be clear the type of funds that the investor and the type of protections that investors can expect. On the other hand, that's not to say that I don't think there are bits of the UCITS directive which are looking rather dated. They were written in the 1980s. They have stood the test of time, but I think there may be opportunities. We've actually, the UCITS directive came in at a time when that was it. That was the only regulation that existed. Since then, we've got various different layers of regulation of the manager and of the distribution process and the distributor. So it may well be that there are elements of the UCITS directive where we could say, well, this is very prescriptive. Do we need it to be prescriptive like this? We've got ourselves in muddles about the fact that liquidity, listing equals liquidity. Maybe we need to think about that. But I don't think it's wholesale change. I think, and we don't need to change the basic structure of funds regulation. But there are definitely opportunities to offer greater choice to European investors.
Thank you for sharing these views, and really enjoy your reflection on the liquidity aspects, which is extremely topical these days in the current environment. So thank you for that. Before going to more details with you, Martin, on LTIF, do you want to add any views on this question of integrated market?
I would take a couple of additional points, which are, if we're getting more Europeans to invest and use the deep pools of savings that already exist in Europe to fund the European economy and to finance long-term savings and retirement, one of the key focus areas is about ease of access. Sheila pointed out that the UCITS vehicle, LTIF vehicles, provide a great portfolio of diversification, risk management. But sometimes the processes that we have across Europe are still quite clunky. They're still quite paper-based. And making it easy for people to access these great vehicles is an area of focus. And one key development we've seen since 2019, 2020 has been huge growth in savings plans through a number of the neo brokers. This is one of the fastest growing growth areas across the European industry. It's still unequal, but it does allow people to put 25 euros, 50 euros a month across a diversified range of funds and start building up those habits of investing in a very simple way, risk managed way, in non-complex products. That foundational behavior will really drive future growth and future integration of the market.
Thank you, Martin, for that. And I will stay with you for the next question, because I said what I would like to talk about now is specifically LTIF 2.0, so which is exciting, as you know. It entered into force a few weeks ago. And the question I will have for you is first to describe what are the main changes and the main improvements which we have seen in the last regulation. And more than that, I will be interested to get your views of to which extent and why do you think LTIF 2.0 is a real opportunity this time? And what are the points we need to pay attention to until the entry into application of the new rules on 10 January 2024?
Thanks, Emmanuel. So for us, the move to LTIF 2.0 is a move from proof of concept to scale up. So the Commission back in 2013 to 2015, when they brought in LTIF 1, was really trying to bring a vision of saying, how do we move capital to private assets? And since then, in the last 5 years, since we've had the first set of regulation, people have really been trying to sort of work out the vehicle, pioneer the vehicle, test the vehicle, work out how it works with distribution partners, work out who is interested in buying this fund, and actually from an investment perspective, what sort of investment propositions really make sense. And so all that practical on-the-ground feedback has fed into LTIF 2.0, and this for us is been a very useful dialogue. It's been a very dynamic dialogue between the industry, between stakeholders, between distributors, consumer bodies, and the European Commission in terms of how you scale up this vehicle. And it comes into 3 areas. And it comes down to sort of marketing, the investment proposition, and fund structure. Those are the 3 key areas which have changed with LTIF 2. On marketing, this is really how do you access the LTIF. The LTIF had its own rules, and they had an entry ticket rule. I won't go into the details of this, but really what we've done in the EU with LTIF 2.0 is align the LTIF with existing MiFID 2 rules. MiFID 2 didn't exist when LTIF 1 was in place. So we have now very detailed rules on suitability, on consumer protection for complex products. This is not the LTIF is a complex product because it doesn't offer daily liquidity, as Sheila was mentioning. So there are rules for portfolio managers, for advised business, to check consumers' understanding of whether they can bear liquidity risk. Do they understand they're not going to be able to withdraw their money next month, in the next 6 months, that this is a long-term commitment? But aligning the rules means you don't have to have a bespoke process, which means you can scale up. Second area is about investment restrictions. Now, we are talking about investing in private assets. A number of the initial rules were very much drawn from the UCITS experience, quite naturally, about how you do concentration and diversification limits. And they didn't quite fit the world of private markets. So there've been a number of changes about how you co-invest in private assets through fund of funds, the ability to invest a bit more in public assets, which is very useful. And we're not so much talking about making a private fund, but actually allowing the fund to remain invested during ramp-up periods or during rebalancing. That if you have if you have an investment that's come to maturity and you still want to invest and you want to take on another investment, you don't necessarily have to hold cash. You can hold a liquid instrument. It also allows you, if you want to invest in private companies, to stay on past IPO, that you can continue to be that long-term committed holder. And then finally, structuring, there will be a little more flexibility around liquidity management. We're going to have a whole set of ESMA consultations coming out this summer around this, but it will allow a little bit more flexibility in having liquidity windows where the portfolio allows this. But I don't necessarily want to oversell this. So yes, there's a lot of potential to scale up. One of the questions, will it become a brand like UCITS? Yes, there's a lot of possibility, a lot of potential for this, on condition that we work with distributors, that we work with end investors on education. And this is about changing mindset and culture. I very much echo what Sheila was saying earlier on this. This is a key point. We see in our discussions with distributors that we need to focus very much on getting them to understand the fund structure, where liquidity is available, where it isn't, how they explain both how private assets work to their end investors to ensure, but also training for distributors on, say, this is not like investing in public assets, and education around liquidity. Yes, we know people are investing for the long term, but there's a default back to, I need to be able to withdraw my money now. So it's that education about saying part of your portfolio will not be accessible in the short term. Make sure you have your short-term accessible assets as part of your diversified portfolio. And then this is part of your portfolio which you leave until fund maturity. So we do expect there to be growth. We expect there to be a lot of growth on cross-border LTIFs, especially capitalizing on jurisdictions such as Luxembourg, which have deep cross-border asset servicing capabilities. But we also expect there to be some more nationally focused LTIFs, which are taking advantage of some national rules, for example, about life assurance-linked contracts or retirement savings rules. So we do expect there to be quite a dynamic ecosystem of LTIFs developing across Europe.
Thank you so much, Martin, for that. And it's really important. I mean, what you say also in terms of education, I think is absolutely key also in this environment. So thank you for that. Sheila, before moving to the next question, do you want to add anything on the ALTIF 2.0?
Yes, thank you very much. I think we do have an exciting prospect of a whole range of types of funds. At the moment, we effectively have completely closed-ended funds and completely open-ended funds. And so the scaling up of the LTIF, I think, offers a great opportunity for a variation of types of investment choices for investors, which is, I think, very good. And the only other thing I would mention is I think this is going to be part of the new world that, of course, in parallel to the discussion that's going on the LTIF in the EU, of course, the UK is also focusing on its version, the LTAF. So I think going forwards, there's going to be an interesting exercise of learning from each other what works and what doesn't work so well. So I very much hope that we'll be, as a house that's operating in both the UK and in the EU, I think we very much hope that there will be close cooperation and discussion between the authorities and the businesses, which are focusing on the UK market as well as the EU market.
Thank you, and I will stay with you, Sheila, for the last question, and we'll spend 2-3 minutes on a question relating to technology, and I will be really interested to get your views on the role of technology in shaping the future of investment fund industry. And one specific question, whether tokenization, in your view, could offer a new avenue for retail investors to access private assets.
Thank you, Emmanuel. Yes, a fascinating question. our chief executive is on record as saying that we have reached peak mutual funds. And by that, he means that maybe in the decades to come, we won't be seeing mutual funds of the type that we see at the moment, but we will be seeing much more personalized portfolios, which are using particularly distributed ledger technology. So I think ledger technology and tokenization would actually enable you, for example, to tokenize a shopping center. And then that can be carved up into slivers and maybe sold to local investors, and can be blended as a part of the portfolio into slivers of other types of assets, which at the moment tend to be illiquid and big and only accessible to institutional investors. And maybe blended also with, you can blend public and private assets together. So I think the combination of being able to access a much wider range of assets, but also very tailored personalization. So if I decided I wanted a range of different shopping centers in London, Paris, and in Amsterdam, I could have that. But if you didn't want to hold the shopping center in Amsterdam, but you wanted to increase your exposure to Paris, you could do so cheaply and very securely. So I think that's going to, and there will be much greater liquidity, because it will be much easier to buy and sell small parts of a shopping center than a whole shopping center. So I think particularly digital ledger technology is both going to be important in terms of the infrastructure of funds and the processes that we have to go through in running funds. But I think there's also exciting opportunities at the investment end to open up private assets to a much wider range of individuals.
Thank you, Sheila, and so exciting times ahead. We are reaching the end of the panel, so maybe one final word from you on this topic, Martin, and then it will be the end of this panel, and thank you for being with us today. So maybe over to you, Martin.
No, thanks very much for that, Emmanuel. Perhaps just to add a couple more points on the technology side. Tokenization and DLT offer a lot of interesting opportunities. There's been a lot of discussion. I think we're at the stage where we really starting to investigate the use cases and see and really look at the which use cases are going to be valuable.
I think, Martin, unfortunately we lost the connection of the very final word. So we didn't hear the very last sentence. So I don't know, maybe...
Apologies for
we hear you again.
Apologies for that, yes. No. So all I was saying is that tokenization and DLT offer a lot of opportunities for the future, especially around use cases linking to collateral management or improved processes in markets. So, for example, if you are using a fund, if you want to access a fund in smaller units than a large unit, tokenization can really help. As Sheila said, it has to be secure, and we have to understand a lot of legal issues around custody, around what are the legal rights to those tokens to ensure that they are as definite as we currently have. So still a lot of work on the legal, custody, and the plumbing side to do, but also a lot of opportunities.
Thank you, Martin, for that. It will be the last word of this panel, and thank you for this great discussion together. It was, I think, extremely insightful, so thank you for that. I will now give the floor to the next panel, which will be discussing securitization and capital markets in turbulent times. It will be moderated by Péporté, who is a partner at Allen & Overy. Thank you and have a nice day.
Thank you, Emmanuel, and good morning, everyone, and welcome to this fireside chat. Let me start by introducing the person I'm going to interview, who is Melvin Goergen, who is the Head of Strategic and Corporate Development at the Luxembourg Stock Exchange. Welcome. Let's start straight away with the first question to set the scene. So, Melvin, for the uninitiated, can you please briefly describe what securitization is and how it works?
Good morning, Paul. So I think the clue lies really in the word itself. Securitization is essentially about taking financial assets and the associated cash flows and turning them into marketable securities that can then be sold to institutional investors like pension funds. Now, for the uninitiated, I think an illustration or example is probably easier to understand. So assume you have a bank that has extended 1,000 mortgages to its retail clients. Over time, it receives interest payments, it receives the notionals paid back, and that's okay. But what the bank can also do is it can say, out of those 1,000 mortgages that we've extended, we will take 400 of those, we will package them together, and we will sell that package, all of it combined, including all the cash flows, to an independent third-party company. And typically they're set up specifically for this purpose. In the jargon we call them special purpose vehicles. That special purpose vehicle then turns to capital markets to finance the acquisition of this package of mortgages that it acquired from the bank by selling securities to institutional investors such as pension funds. Now, the logical question is, why would you do that? What is the benefit of it? Well, on the one hand, the bank ends up offloading some of the mortgages it has on its balance sheet, freeing up more capacity to do new lending. And on the other hand, pension funds now have access to retail mortgages, which they themselves couldn't do on their own. So it's in a way, it's a win-win for both sides. And obviously, this is an oversimplification. And in reality, there are a lot more nuances to it. You can add bells and whistles, and the whole thing is slightly more complex. But at its most basic, that's what securitization is.
Thank you, Melvin. So originally, I think the reshuffling of the European regulatory framework on securitization was really driven in order to boost the European securitization markets and also the European Union's position in global capital markets more generally. So how would you say does securitization fit into the capital markets union? How does it help to fund the economy? And maybe can you explain why securitization is so important in this CEMU?
Yeah, so if we go back to the illustration I just gave you, if a bank can have 1,000 mortgages, and let's assume for simplicity that's the maximum it can do for capital reasons and other reasons, through securitization it can shift some of this off its balance sheet and create capacity to extend another 400 loans to retail customers or companies or whoever else might require financing. So it's really a mechanism of multiplying investment or capital that's available for investment for the real economy. And this is something that the European Commission recognized very early on and made it a key pillar of the Capital Markets Union proposals a couple of years ago. And that's why also there's been this big push to have a sort of a unified framework under the securitization regulation in Europe to make sure that our capital markets can provide this type of financing to the real economy.
And would you say, is it gaining traction? And can we manage to compete with the US in this respect?
Yeah, I think to an extent, direct comparisons between Europe and the US are slightly misleading, not necessarily helpful. If we just look at the numbers, and the numbers are, they're estimates. There is no database that tracks all of this, but purely on the estimates, we had about 200 odd billion of issuance in 2022. And that's roughly in line with sort of the last 10 years, plus and minus 30 billion. So it was an okay year. It was down on 21, but it was still a large amount of financing being done through securitization at 200 billion. If we compare that figure to the US market, well, the US market was 10 times larger in 2022. In 21, it was 17 times larger, so huge. But what is missing in that explanation is that the US market, actually 80% of it is government-sponsored entities that securitize US mortgages. So here we're talking about Fannie Mae and Freddie Mac, for example. There is no similar institution in Europe. So essentially, you can't really compare the two from that perspective. And what Europe has, which the US doesn't to the same extent, is a covered bond market, which is a different form. It's not securitization, but it has the same or similar effect to securitization. And here Europe is leading the world. It has the largest market share globally. So I think if you want to compare the two markets, you need to take into account the actual idiosyncrasies of the local conditions and how financing works in the local economies. So I think overall, cutting a long story short, it is a large market, it is working, it is available for the European economy. But I guess in a way, when the securitization regulation came into force, the Commission had hoped that volumes would increase further than they have so far. But I think overall we are in a good position.
It's interesting, in particular also the point on not comparability between US and EU securitization markets. And there I think it's also interesting to mention that even within the European Union, nothing is homogeneous in the sense that we have a European-wide definition of securitization, which is used across the board for regulatory purposes. But then each member state or a number of member states actually have their own legislation on securitization. And there again, the concept of securitization can be very different. And for instance, Luxembourg has a thriving securitization market by using its Luxembourg law on securitization. And there the definition is far broader than what you would have in the concept of European securitization. And then in turn, well, you can nevertheless structure transactions via this broader Luxembourg definition and nevertheless help the European economy and basically bring more debt to the market with this broader concept of securitization. So I think that's probably something to be taken into account before comparing. Maybe let's move on to the next question. I think several months ago, we had seen the French and German treasurers writing to the European Commission and urging officials to back proposed measures to support essentially the securitization market. And these measures consisted mostly in alleviating the capital requirements or recalibrating the capital requirements for banks, also rethinking the way that insurance companies invest in securitization positions, and even going further also in respect of disclosure obligations to facilitate disclosure requirements in securitizations in order to manage overall costs. Can you perhaps let us know where this is currently sitting and what updates might be relevant for the audience?
Sure. So when the regulation came into effect in 2019, there was a provision that asked the Commission to review the impact and the performance of the regulation 3 years after going live. So in 2022, about six or 7 months ago, the Commission actually released a report that reviewed the regulation and the impact it has had. And this was based on stakeholder feedback, and by and large, the conclusions from the Commission are that the regulation is fit for purpose, it serves its purpose, it does what it was supposed to do. They do recognize that the volumes that we just alluded to are probably slightly muted versus expectations, but overall, things are going in the right direction. They do also recognize that certain aspects can be further improved, notably the disclosure requirements. And so here they have asked ESMA to review the templates that are being used for this purpose, and that's an ongoing process. When it comes to the capital treatment, both for banks and insurers, the Commission's report actually came out before the European supervisory authorities reported on their own analysis of this. So the Commission report didn't take this into account, but in the meantime, that's come out, and the European supervisory authorities essentially conclude that from an insurance perspective, everything is okay and nothing major needs to be changed. And for the bank regulation, they're basically saying, well, let's not do this in Europe alone. Let's wait for the Basel Committee to come back with global proposals and therefore then tweak the European regulation to the extent we need to. So I think hearing that the Germans and the French are making another push on this, I think, is a natural way of how these things evolve in Europe. The Commission overall, it is an objective of the Capital Markets Union to advance securitization. So in a way, I think they're pushing an open door and everyone's pulling in the same direction. But we should also bear in mind that securitization, at least in the original form in 2008, the financial crisis, played a major role, or tweaks actually to the regulation played a major role to the negative effects that we felt globally when the US securitization market got into trouble. So I think overall we should take a cautious approach when we tweak it. And I think that's what the Commission has been doing. They've not rushed into this, they've consulted, they are changing things, then they're waiting for feedback, they are revisiting the effect of the changes. So I think overall we are really in a place where Europe has a very prudent approach, a very business-oriented approach, And I feel confident that in the future we will have a securitization market that is truly delivering for Europe.
Yeah. Well, it's interesting to see that particularly the French and the Germans are pushing ahead, and indeed maybe in the longer run we can expect some, let's say, flexible approach by these major countries in revamping CRR, so the bank's capital regulations or other regulations in a securitization-friendly manner. So that I think is probably positive. I think what to come back also on the various ESMA consultation. Indeed, what we've heard on our side is that this ESMA consultation has informally already been launched, and we expect that the official launch for the consultation on disclosure is imminent, and so the expectation there is that there should be alleviated disclosure obligations for private securitizations, which I think is a positive message to the market.
Yeah,
but let's see where we end up there. Thank you. Maybe to switch slightly the subject, I think we've seen that securitization is important as, let's say, providing an additional tool of funding without necessarily having an impact on capital requirements of banks. How does that react in connection with market shocks? I think we've seen the COVID crisis being a big, let's say, opportunity also for securitization to be there and show that it is an alternative way of funding. Now, today, we are in a slightly different environment with rising inflation. What do you see the impact on securitization there?
Well, it is notoriously difficult to predict, issuance volumes because there's a multitude of factors that come into play. The fact that we have high inflation or potentially persistently high inflation, the only solution that monetary authorities really have is to raise interest rates. That in turn has a mathematical impact on securitizations and securities that have been issued because basically through high interest rates, swap curves increase, you have credit spreads going up, etc. So basically the yield on existing securities increases. By consequence, the price has to fall. So holders of existing securities essentially sit on at least temporary paper losses on existing holdings. That should negatively impact their appetite for new issuance. On the other hand, higher interest rates mean new issuance, new deals will come with higher coupons and therefore already a higher yield embedded, making them attractive to investors. So you have sort of this mathematical tension going on. At the same time, high interest rates also have an impact on the real economy. So there is a risk that by pushing up interest rates, unemployment will rise, we might potentially enter into recession, we might have an impact on default rates, on mortgages and so forth. So all of this impacts the quality of existing portfolios that underlie securitized securities. And at the same time, I think we need to bear in mind that the negative impacts that we had feared, or many people had feared would come through, haven't really materialized yet. We're not really in a recession. We don't really have high unemployment. Households still have very high savings rates. So some of these tensions are currently still offset. Whether they come 6 or 12 months down the line, it's a possibility, we don't know. So I think overall, you have this push and pull between different factors that impact overall issuance volumes. And I think bearing in mind also that if the housing market, for example, slows down, there are fewer mortgages being issued by banks. Therefore, there is a lower need to actually do securitization because there's fewer mortgages on the balance sheets. So when you take all of these factors into consideration, my estimate would be that we would see a slowdown over time of the volumes that are being issued. But at least where we stand today, I don't think it's a catastrophic move. It will temper volumes in the short term, but I'm fairly confident in the long term with the securitization regulation in place, the markets recover and we will see further real funding going into the economy by means of the securitization market.
Thank you, Melvin, for sharing these interesting perspectives on securitization. I think this already closes our fireside chat. So thank you very much for responding to all these questions. At this stage, let me hand over to Chris Hollifield for the next session on onshoring liquidity within the EU. Thank you very much.
Well, thank you, Paul, for that very interesting fireside chat. I'm now going to move on to another topic which is very relevant to the CMU plan, which is that of clearing. And I'm delighted to be joined by two experts in this field to discuss this important topic. Firstly, Philip Whitehurst, who is Head of Service Development for LCH's rates derivative business, which includes SwapClear, the market-leading swap clearing service operated by LCH. And Matthias Graulich, who is the Chief Strategy Officer and member of the Executive Board of Eurex. Thank you both for joining us today. Maybe just to kick off, in December 2022, the EU Commission published a proposal for a directive supporting the EU's open and strategic autonomy in the field of clearing, specifically by requiring EU-based firms to be subject to a clearing obligation to hold an active account at an EU CCP. Maybe to begin with, you could tell us why that matters in the context of CMU and why it's an important measure. Maybe kicking over to you first, Matthias.
Yeah, no, happy to take a perspective on this. So, as you mentioned, it's about the EU's autonomy agenda. And here, from an EU perspective, you want to be in a position to manage your systemic risks appropriately. And ESMA has, back in 2021, identified 3 financial products which are deemed systemically important from a risk perspective, but also from a monetary policy perspective. And these products are euro-denominated interest rate swaps, euro-denominated credit default swaps, and Euribor futures. All these products are, to a very large degree today, being managed by market infrastructures outside the EU, primarily London. And following Brexit, there is a limited kind of oversight and intervention possibility from EU authorities. So the question now from an EU perspective was how to regain control over these systemically relevant products post-Brexit. And what we've done on the Eurex side, back in 2018, we started a partnership program, an approach to build a liquid alternative for clearing euro-denominated interest rate swaps within the EU. And I think we have seen some success in that regard. We have onboarded 600 clearing members and clients. We have, from an outstanding perspective, achieved a 20% market share. We see competitive bid offer spreads shown to end clients. So I think overall a success, but obviously the 20% seem not sufficient from an EU Commission risk management perspective. And then the question from an EU's perspective is, what do we do? And the extreme options are do nothing. I think that's not really an option because the 5-year period has shown only kind of some progress, but not the progress people were expecting. The other extreme is a straight location policy, which, for example, Japan has done many, many years back. But we are also not in favor, and I think no one is in favor of a straight location policy because it has a lot of unknowns and potential risks. So, and now referring back to the active account requirement, which is currently stipulated in EMIR 3.0, I personally we think that this is a fair middle ground, a compromise between the extremes, and it gives flexibility to the market on the one hand, but it also is some stick in a sense that regulators and central banks achieve their ultimate objective to get a better rebalance of positions in these systemically relevant products.
Okay, thank you very much, Matthias. Maybe kicking it over to you, Philip. Obviously, LCH is primarily based in the UK and is operating through that temporary permissions regime currently that Matthias mentioned. What do you see as the potential impact here from your side?
Yeah, well, perhaps you won't be surprised here. Don't necessarily agree with everything that Matthias has said. There is an awful lot to say, but since the question starts really about the context being CMU, if you don't mind, I'm just going to read a couple of stated ambitions of CMU, which are to get money flowing across the EU so that it can benefit consumers, investors and companies. And it goes on, EU capital markets remain fragmented. This means that European citizens and businesses are not able to fully benefit from deep, competitive, efficient and reliable sources of funding and investment that capital markets can offer. So I think if you look at this question in that context, it's really hard for us to see how the Commission proposals for active accounts helps towards those objectives. Let me sort of put that in a bit of context. OTC derivatives markets are global by their nature. The major international currencies that facilitate global trade, obviously primarily the dollar, but also euros, trade in global markets. The infrastructure that supports them therefore necessarily needs to be global. And that's how things are in clearing at the moment. As Matthias mentioned, some impressive statistics there on how Eurex is getting on, how LCH are doing. That's really in a healthy global level playing field at the moment. And that's really where CCPs compete on merit for customer business. So what is that business? Well, if we look first at euros, and we look at the split between domestic and foreign involvement in the euro swap market, then I think we should first reflect on the fact the euro swap market is already more international. About 68% of euro flows are non-EU, so that's more international than, say, US dollars, where the equivalent stat is 62%, and other major currency comparators. So that's a real success story, something to celebrate and promote, something the EU is no doubt looking to support. So how you can, on the one hand, think that the market is fragmented and impose an active account requirement, which goes right down to the level of individual firms and individual portfolios, and reinforces that fragmentation, limits that free choice. That does seem odd to us. I mean, if we look at it from the other perspective, EU firms are also really active in non-euro markets. They trade just as much non-euro business as they do in euros. They trade dollars, Japanese yen, they trade Canadian and Australian dollars, trade in Latin America, the list goes on. So to remain globally competitive, EU firms desperately need access. And remember, these are the EU's own words: deep, competitive, efficient and reliable sources. That's where we are now. And if anything, we think the proposals cut against that. So I won't go into any more detail now, but we then ask, well, if those are the obvious costs, what are the benefits? We see risks. We'll perhaps come on to this in the later question, from concentrating a marketplace with within a smaller number of active liquidity providers, and does that really improve resilience under stress?
Great.
So you've got obvious costs, you have debatable benefits. I think that the next question is, do you have other solutions? And I think the answer is yes, you do. We have demonstrably better solutions available. Enhanced supervisory frameworks are, we think, the right way to address any of these concerns. And maybe just lastly, Chris, you've mentioned that LCH, is a London-based firm. I just want to say, in fact, we have a Paris-based operating company, as well as a London-based operating company, and we offer services according to the specifics of the marketplace from either the London-based or the Paris-based opco based on our customer preferences. So I think, again, we see this from both sides, and I think it's important that that comes across in our perspective.
Great, thank you very much. Thank you very much for that response, Philip. Maybe coming back then, I mean, obviously the key elements there being the internationalisation and the potential fragmentation of a market that is actually already concentrated. So, Matthias, maybe you could jump back in terms of how do you see this? Are there risks? Is what Philip is saying here accurate in your perspective? What would you say?
Well, I mean, I would have a number of comments on what Phil said, but on the fragmentation aspect, I mean, I think the EU Commission in this statement is pretty much referring to the cash equity markets, which is a highly fragmented market, and we talk about dozens of pools. Here we are talking about 2 pools. Whether we can compare that with the fragmentation statement which was made, I'm not entirely agreeing with that. But let me come back to your question on the risk associated with. I think for these systemically relevant products, from an authority perspective, you want to make sure that three things are working. First of all, you want to make sure that the market infrastructure where these products sit are adhering to minimum standards. These minimum standards are currently defined in EMIR for the EU, and here clearly, based on all the statements we have heard out of the UK, there is some risk of regulatory divergence down the road. Second, you want to have direct supervisory rights for this market infrastructure where these systemically relevant products sit. And thirdly, which I think is most important, you want to have the ability to take action if something goes wrong. And this ability you want to have in particular in times of severe market stress. Now, if I remember correctly, David Bailey from the Bank of England said at one point, he is very happy for other regulators to look over his shoulder, but if it comes to UK-based market infrastructures, there's only one institution sitting at the steering wheel, and that's the bank. So you can see that this is obviously a challenge if you have these kind of products sitting outside the EU and outside your control. And from an industry perspective, I mean, this is now the regulatory and political perspective. But if you look at it from an industry perspective, you want that the central bank and the regulators are in a position to intervene in certain instances. And because if they don't, it might mean massive cost to the industry. And we have seen in the UK, most recently, an example with the announcement of the mini budget and the deterioration of gilt prices massively, which required an immediate intervention from the Bank of England. And even with that intervention, there were quite significant costs to the industry, but we all wouldn't want to think about what would have happened if the Bank of England would not have intervened in that situation. And I think these type of interventions in the context of clearing, of course, are just possible in an efficient and effective way if the business or this relevant business sits to a larger degree within your jurisdiction and in your remit.
Great, thank you. I don't know if, Philip, you have anything to add there, otherwise?
Yeah, I got a couple of comments, to make. I think, first, I suppose, as a general matter, this is all about risk management. I think, Matthias, certainly we think we are risk managers, so we look very hard at the best place and the best way to arrange the risk management frame that we have, and I don't think you necessarily need to focus first on where that risk management is taking place. I mean, if we take your repo, for example, market demand has led us to consolidate our Euro repo offering into the Paris-based entity that I mentioned. That's, I guess, to do with the market dynamics and market participation. Swaps, on the other hand, they are a global market. As I mentioned, around 70% of volume in the Euro swap market is non-EU firms, and we think it's really important, therefore, to recognise the global nature of that marketplace in the clearing arrangements. Maybe just to pick up a couple of the things that Matthias has mentioned quickly. He talked about minimum standards. What we find, the way our business is operating globally, we essentially are held to sort of the highest of high standards. In each case, we're directly supervised, to another of Matthias's points, by ESMA. So we are entirely compliant and in keeping with everything ESMA demands. But also the CFTC has requirements based on a DCO license that we have. We're authorized in Canada and Australia, and they have their own requirements. So we have, if you like, a very high bar because of all of those, and that really would go for generally for global businesses end up operating to those high standards. And maybe the last point, Matthias mentioned the mini budget. Well, I think that's in fact a perfect example of where you want a wide diversity of players in a marketplace. There was a great degree of concentration in certain UK sectors, which without that international involvement probably could have made the situation even worse. And that concentration is a risk unless you have a wider set of users involved in a market. So yeah, just those are a couple of thoughts on that matter.
Okay, maybe just, I'm conscious of time, but so maybe just to wrap up quickly and sticking with Philip, and I suspect I know the answer here, but what would, in an ideal situation, what would you expect the future of clearing to look like in a European context? Maybe just very quickly.
Yeah, well, from our point of view, we compete already with Matthias's business and with other businesses. We want to see that free choice for customers to be maintained. So for us, constraints such as active account requirements are not necessary. We think the solution lies very much in any enhanced supervisory arrangements, such as those that already exist between the various international authorities in relation to other marketplaces that we support. And so from our point of view, a global market needs a global infrastructure. We need the fewest constraints possible, and we want a level global playing field in which we can all compete and customers get to make their choices, based on the merits of the suppliers.
Great. And then last words for you, Matthias. Same question. What's the ideal future here?
Yeah, well, I think I firmly believe that the benefits clearing more business into the EU will supersede any potential incremental costs in the midterm. And the value proposition Eurex delivers around the home of the euro yield curve is I think, a key theme here. There might be some transition costs, but these transition costs are to be assessed in the context or against the potential costs coming to the industry if something really goes wrong and there is no possibility to intervene in a very effective and efficient way. So in terms of ideal outcome, I think we are not too far apart. I think what we need is a rebalancing of the risk between the EU and third country market infrastructures in order to allow the EU Commission to say they are not overly systemically relevant to the EU anymore, which would be the basis to declare a permanent equivalence to these countries and CCPs. And ultimately, I think it would bring continued competition. It would allow continued choice between different venues, and in parallel, it allows the EU to manage their risks in the most efficient way and drive their autonomy agenda forward.
Great, thank you very much. Well, I mean, obviously this is a very complex topic, and I think is something that is going to be, in heated discussion by the sounds of it for some time to come. But thank you both for coming, Philip and Matthias, today and sharing your insight with us. And now I'd like to hand over to Inès to wrap up this event. Thank you very much.
Thank you very much, Chris. Ladies and gentlemen, our event has come to an end. Let me restate the main points here. We are making great strides in building an integrated capital markets union. There are great initiatives such as the retail package, the multiple vote share structure, or building an ever more efficient securitization market that will serve the green agenda. We are building an even more integrated funds market, moving progressively from UCITS, fine-tuning it, AFMD, and LTIF. Nonetheless, we cannot disregard that there are still challenges down the road. For instance, just to quote an example, LTIF has opened up the way to the retail investor for alternative funds. Nonetheless, there's a great deal of education that still needs to be done. We have to educate on liquidity. Daily liquidity has been sacrosanct for years. Now, our challenge is to educate investors on how non-daily liquidity is not necessarily equivalent to more risk. We have to educate them on private markets, and on which respect they differ from public markets, the way of investing, what's a co-investment, for instance. Nonetheless, we're confident we will reach a great capital markets union because we have a very strong commitment to it, a very strong commitment to this initiative, as the EU is committed to creating the economy that works for the people, as Ursula von der Leyen, the president of the European Commission, put it. So I hope you found this event insightful and that you've enjoyed it. I would like to thank you. I would like to thank our speakers, a big thank you, our audience, as well as our sponsors, Allen and Overy, Clifford Chance, the Luxembourg Stock Exchange, Elvinger, Haas and Prussen, and GSK. Thank you very much, and hope to see you all at our next Focus on Cybersecurity. It will be held on the 14th of June. Thank you. Bye.